You've probably seen this everywhere in the last month. It's the stock buying opportunity of a lifetime. But here's the thing. Most people say this in one or two situations. After stocks start going back up, or second, when we aren't used to real bear markets. You know, I said this recently, and so did Warren Buffett. And yes, I'm not trying to say that I'm Mr. Warren Buffett. But when I hear people talking about what a catastrophic crash we had recently, I said, guys, 15, 20% drop is nothing. And Buffett said the same thing at his annual meeting. The real opportunity is when mainstream investors think that stocks are a bad investment and should not be touched. That's when they become undervalued, and that's when you should be buying. Not when a few people here or there. In this video, I'm going to show you how to spot true value before the crowd catches on and walk you through a few real-life stock examples. But remember, if you catch before everybody else catches on, you're not going to find the bottom. In fact, you're never going to find the bottom. The reason why the opportunity of a lifetime headlines show up after the fact is because people want to see like they saw a bottom. They want to sit there and have the Mr. Market, the stock market price, validate kind of the concern. When does that happen? Not here, but kind of here. And the people will sit there and say, this is an opportunity of a lifetime, to which I would say, well, why not here? The problem is people feel like they're catching a falling knife. That stock going down, they're catching a falling knife is a bad thing. I don't agree. If you truly understand value, if you truly understand that when you buy a stock, you're buying a piece of a business, and if you pay a reasonable price, as that business makes more and more revenue and profit, your intrinsic value will go up. Then you're going to do very well. Now, the hard part, the reason why people fall for this emotional and psychological trap is they look at the market prices to determine whether they're right or wrong in the short run. You should not do that. If you're waiting for true momentum, you're going to miss out on buying along the way down. That's what's really important. It's impossible to buy at the bottom on purpose, to identify the exact moment. All you can do is say, this is a good value, and I'm going to buy it here. So the question should be, well, what's a good value? Well, that's what we're trying to teach on this channel. It's not just about the numbers, but on this part, about understanding what real value is, you have a company. It's generating revenue and profit. You have a story. Now that story is going to help determine what could happen in the future. And that's what we're trying to do here. We don't know the future. So we have to make several assumptions, which we do. When we have our stocks here, let's pull up Nike, for example. We have our stock analyzer tool. This is the tool we use to merge story with the numbers. You make assumptions about revenue growth, profit margin, free cash flow margin, some sort of earnings multiple, PE, and then your desired return, and you make your years of analysis. I usually pick 10. When you make these assumptions, low, middle, and high, it's going to give you a wide range of prices. That's what makes investing difficult. It's an art. We have to sit there and determine, based on these assumptions, what's a good price. Now, for Nike, for example, it's currently selling for $62 a share. But let me show you guys something. In the last 5 years, it's down 27%. When this was happening, we were making videos on Nike saying, listen, we don't know exactly the price, but I'm interested under 100. Guys, I encourage you, go back and look at our videos. People telling us Nike would never be below 100. It's such a great big company, it'll never fall that much. Guys, in the last year, the low is $52. That's a fall of 70%. When you see this, how do you not sit there and say, all right, there's got to be a disconnect somewhere? You look at companies like Intel, Cisco, another great darlings of 2000. Each of those companies is generating more revenue and profit today than they did back then, yet those stocks have not even matched. Let me show you. Cisco, look at its all-time chart. It is below its all-time high of 2000. Below its all-time high. But look at the income statement. Last year, in the last 12 months, it did $54 billion in revenue and $9 billion in profit. Let's go to the year 1999, right before the big bubble. $12 billion in revenue, $2.67 billion in profit. So 4 times more revenue, over 3 times more profit, and the stock still hasn't rebounded. And guess what? It's selling for 19 times free cash flow and 27 times earnings. It's not exactly super cheap. It's not like it's selling for 3 times earnings. I'd say, okay, that's the problem. No, you know why it is? Because it was just so overvalued here. Don't look at stock price movement to determine if you're right or wrong. Use the fundamentals getting better. So the way to find undervalued stocks is you have to sit there and look at the stock analyzer tool, input your numbers, and is the stock selling for below the intrinsic value you've determined? Let's pull up a stock here. Let's pull up Palantir. This is a company that's absolutely killed it lately. In fact, in the last 6 months, it's up 103%. Year to date alone, 64%. In the last 1 year, 500%. Now, what's interesting is, back when Palantir was at $45 right here, I said I was interested around $5, and I got blasted on the internet. Paul, you're an idiot. You don't get it. Blah, 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 blah. Guys, you can't see it because of how big the chart is. It got to $5.83. Now, I never bought it because I have other issues with the company. I have issues with the CEO and how they report earnings, etc. But the point is, was I right because it was $5.83 versus $45? Maybe. Do I think it's worth more than $5.83? Yeah, I do. So was I right by it going down? It just maybe was just luck. But now it has surged to 123. Its high is 125 back in February. So it's near all-time highs. Do you consider yourself right here? Okay, well, a lot of people are jumping on the bandwagon here saying this stock is soaring, it's skyrocketing, it's great. But guess what? It's still a $315 billion company selling for 100 times its revenue, selling for 240 times its free cash flow, and 550 times its earnings. Is that reasonable? I don't know. Now, if they're going to double their profit every year for the next 20 years, I would absolutely buy it at this price. But is that likely? That's the question you have to ask as an investor. What needs to happen for this to be a good investment? Whether it's undervalued, because remember, if a company's undervalued, they could have issues that are making the stock decline. That could be the case. A lot of times that is the case. But you have to remember that use the market emotion to your benefit. Find the big companies that are not going to be replaced, that can't go away, that are selling for cheap prices because people just don't like stocks. That happens. It's very rare, but it happens. And that's what we're trying to figure out. So I look at Palantir here, and we look at our stock analyzer tool, like I was talking about with Nike. Let's put in some assumptions for Palantir. I'm sitting here, and guys, I'm going to call it 10 years of 15, 25, and 35% revenue growth. That's a lot. Profit margin, 35, 50, and 65. Keep in mind, they've never hit that. But I'm going to give them 50% profit in the middle section. PE and price of free cash flow, 20, 25, and 30. The market average is 15. They have a low return on capital. But I'm giving them a premium in 10 years, assuming they're just the dominant force in that industry. And I'm going to put a 12% return in, put a little margin of safety in there. I hit the analyze button. Low price of 15, high price of 175, middle price of 55. So even assuming some pretty middle assumptions that are good, it's still expensive based on these assumptions. Could I be wrong on these assumptions? Hell, if they crush the top numbers, it's worth it today to make 12% return. My question to you is 12, actually it's 16% return based on today's price. Is 16% enough for the downside risk there? I don't know. That's what's hard there. Now, another example of a company is a company I own. And remember, don't buy a company just because I do. But my thesis on Southwest Airlines is this. Let me show you. Southwest Airlines is an airline, which is a tough business to be in. But look at their profit margin. 2% last year, minus 0.65 in the last 5 years. Before COVID, they were in the 10 to 15% range the entire time. They've had some issues lately. Nothing is better than finding a great company with temporary issues. All their issues are temporary, in my opinion. They're changing the way in which they run the business. I look at this company saying, this is a company that I think can get back to 10 to 15% profit margin in a few years. What's it worth then? Because if you look at it based on today's numbers, it's terrible. 33 times earnings, but on net income of $540 million. Guys, before COVID, they were making $2 billion plus a year. That's incredible. So their profit's down 75%. That's what's amazing. Now let's pull up our stock analyzer tool to merge the story with the numbers. We pull up Southwest. Guys, I didn't even make crazy assumptions. I sat here and did 2, 4, and 6% revenue growth. Look at this. Profit margin, I only did 4, 8, and 12% even before they were at 10 to 15%. So I feel like I'm being conservative here. PE, 12, 14, and 16, and a 9% return. Now this 9% return is the market return. No margin of safety in here. Hit the analyze button. Guys, I have a low price of 24, high price of 113, middle price of 60. Remember, I have their profit margin at 8%, which is still, 8% is still 25 to 40% lower than their pre-COVID numbers. So I look at this saying, there's a lot of margin of safety in here in these numbers alone. That to me is chasing hype versus chasing something that's mispriced temporarily. That's what I want you to do. This is what principle-driven investing looks like. We are investors, not speculators. We don't buy something just because the market price is going up, and we don't avoid something just because it's going down. What we're trying to do is, there are 5 tenets of principle-driven investing that are so important. We're investors, not speculators. Every investment is the present value of all the future cash flow it's going to generate. So whatever you pay today, your return on investment is going to be determined by how much cash flow it receives in the future. The more you receive sooner, the better you're going to do. If we don't understand it, we don't invest in it. A lot of people say about Palantir, what do they even do? Fourth one is, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. So what's popular in the short run is going to go up. What's not popular is going to go down. But in the long run, the fundamentals will drive the stock price. And the fifth and most important one, a great story at the wrong price can become a bad investment. Now, I want you to understand these like you go to bed at night understanding these. You can apply this to bonds, real estate, stocks, businesses, anything. So if you want to have these and there are further explanations, click the link below. We will email it to you immediately. A free PDF sent to you immediately so you can really understand these tenets and apply them into your life. Now, if you want to stop guessing and start investing with confidence, the full course on stocks is where I show you exactly how to build a principle-driven approach to investing, because chasing headlines momentum is not a strategy. Understanding value is. So click the video linked on the screen and I'll walk you through the entire process. Thank you for your time.